Hi, good evening, everybody. Look, I will spare you greeting me back. Good evening. You're a very polite lot. Bunch of students here. So, if you ask a science student what's 2 plus 2, he'll tell you it's 4. Don't be stupid, right? You ask an economist what 2 plus 2 is, he'll tell you, look, over the long term, it should be 4. It may deviate sometimes, 1 or 2 standard deviations, but over the longer term, it should be 4. And unfortunately, that's also the sort of advice you get from most investment advisors. Look, from what we have heard, it seems that market timing is a dirty word. And yet, the organizers asked me to talk about global trends in market outlook, which means they asked me for market timing. Now, how do I square this? And I'm one of those people who are paid to advise clients on market timing. That being the case, and seeing as you asked me to talk about market timing, I'll stick to what I've been asked to do, just talk about market timing. Now, one of the biggest problems that I get when I deal with my clients is, and my clients range from the mass affluent, because I'm not just a chief investment officer for the private bank, I'm also the chief investment officer for DBS Bank, Consumer Bank, and Wealth Management as well. So I deal with a whole range of clients. The biggest challenge that I have is that clients are not clear what the timing is. They're always coming to me. So how do you feel about the stock market? First question to that question is, which stock market? Second question to that question is, are you talking long-term, medium-term, or short-term? They'll always say long-term, but after 4 months, if they don't make money, they'll score you. So I have to be, and I will be very explicit, and I hope I'm not one of those economists. By confession, I'm an economist by training, but I am paid to invest clients' funds. Apart from being the CIO of DBS Bank, I also serve on the board of directors of Nikko Asset Management. So I am tasked with investing both clients' money as well as advising clients on how to invest their money. So when I talk to clients now, what the outlook for the global market is, my answer is very direct. Over the next 12 to 18 months, the outlook is lousy. All right? Got it? 12 to 18 months. Be very specific about it. Right? And it's based on not just economics, although I am an economist, but I don't rely exclusively on economics. It's based on what I call market economics, which is that part of economics is very directly related to stock markets, equities market, not just stock markets. I advise them on bonds. I have a bonds team as well, and I have an equities team, and I also deal with a whole bunch of derivative instruments as well. On the fundamentals, on the economics, there are cycles. Nothing lasts forever. I remember saying exactly those words in October 2007. I didn't know it was the end of the market cycle, but there are certain methodologies that allow you to weigh the probabilities, and the probabilities told me, look, I'd rather say this is probably close to the peak of the market cycle. And I'm repeating this now for the first time in many years. I think we're close to the peak of the market cycle. If you look at US stock valuations, they are now, if you use what's called cyclically adjusted price to earnings ratio, I don't want to bore you with it. Essentially, stock valuations in the US market, and the US is important because it is the biggest market in the world. And it's around the US market that the rest of the world pivots and turns. A lot of people say China is becoming more important. I would agree with that. But the US still remains the most important market. And for that reason, I focus on the US market. Valuations have peaked. They are reverting. They are back to where they were in October of 2007. Stuff being reverts. Nothing lasts forever. And if you look at the earnings, at the end of the day, when you buy a stock, you are buying it for the stream of income that particular asset, any asset, whether it's a stock or a bond or a house, you're valuing it on the basis of the discounted cash flow. Yeah, you've learned DCF and net present valuation. Now, profits, corporate earnings are absolutely critical. And around that you can get variations, but if corporate earnings start pulling back, that's done. And US corporate profit margins have peaked. They've tested the peaks several times and they seem to be unable to clear it, and the logic is clear. In the early days of a recovery from a financial crisis, unemployment is high, workers will work harder, they won't dare to demand a wage increase. Are you crazy? You take a wage cut, right? So you get cost efficiencies, you drive down your costs, you drive up your profits. Unemployment has gone down dramatically in the US, wages are going up, and profit margins have peaked and they're mean reverting. And you can see this now in what we call the index earnings of the S&P 500. It's gone flat. Last quarter went negative, and I'll bet you this quarter will either be 0 or -2. So it's mean reverting as well. And with that, I think the stock market is increasingly vulnerable. And through this cycle, because of what we call ZIRP, Z-I-R-P, anybody knows what that means? ZIRP, zero interest rate policy in the US, it's driven a surge in borrowings. So, and that's been the engine, one of the engines that's been driving the stock market. Well, that too has hit a peak and is also been reverting. The margin debt on the New York Stock Exchange as a percentage of US GDP, it's finished. It's coming down, and as leverage comes down, how shall we say, the turbo power for the market gets taken out. Emerging markets are cheap, and I hear that all the time. But why wouldn't you, if you think the US is expensive, why wouldn't we be buying emerging markets right now? Right now, yeah? We're talking right now, okay? Simply this, they are cheap because the earnings are going down. Asia, ex-Japan, emerging markets are both in an earnings recession. And if your earnings are going down, it doesn't matter if it looks cheap now, because there's a P, there's an E. If the E is going down, your PE goes up, right? Even if it looks cheap now, it can look pretty expensive if this keeps going on. Timing. Timing is absolutely critical, and I'm mindful of my time too. Now the monthly charts, and I use both fundamentals and technicals, right? I use technicals, I use fundamentals, and if momentum is a dirty word, then I speak pretty bad language. I have some really foul language. I am a momentum person. I use economics, momentum, I use trend indicators, and all of these indicators are telling me that we are fairly close to where we were in October of 2007, whether we're talking about the S&P 500, the Dow Jones Euro Stoxx 50, or the Nikkei 225. It doesn't mean it has to happen next week. It won't happen next week, in fact. It won't. Because what we're doing here is, must be clear, I'm looking at a monthly chart. Monthly charts can play out over many months, right? Indeed, what we are telling our clients now is trade the rebound. We called it in July, or was it August, that there was a pullback in the markets, a sharp correction in the markets. And late August, we said go back and buy it in again. Now, is that speculating? Guilty as charged. And my only task is to make sure my clients are still happy with me after that. And there are a lot of other indicators that we look at. So you don't look at just one market. Sometimes you have to look at different markets to get a sense of what's happening in the equities market, the stock market. You sometimes have to look at the currency markets. You have to look at the bond market. And one of the indicators, one of the many indicators that we also use is to look at the performance of the long-term US Treasury ETF. You've heard that expression, the exchange traded fund. Versus the S&P 500. It's hit a cyclical low, which means US government bonds have performed as poorly, as likely in this cycle relative to the S&P 500. Could it go even lower over the next month? It's entirely possible. I only work on probabilities, but I have a pretty good conviction that over the coming months, those probabilities will play out. That instead, it will be the stocks that will be underperforming the government bonds. You look at the currency market, you look at the Sing dollar against the Japanese yen. Why Sing dollar versus the Japanese yen? The Sing dollar is a pure play global trade currency. Nothing else in Singapore but trade. Nothing else in Singapore but finance and trade. And as the global business cycle turns down, the pure play currency gets whacked. But why the yen? The yen is the Japanese are net creditors. Japan is a net creditor nation, the second largest net creditor nation in the world. So as long as you understand that even with all its problems, the yen is a net creditor currency. And what happens when there's a downturn in the business cycle? People don't want their capital anymore. That's when Japanese capital goes home and sleeps with the bears. And when it goes home, it pushes up the yen. Then at time frames, that's monthly. So this can play out over the next, as I said, this is a 12 to 18 month view. It doesn't mean it takes 18 months to come true. It means it takes 18 months to play out, the top to down. Then you have your shorter term time frames. Again, you can, if you have the guts to play against the greater trend, which is down, you can trade it out, right? And I'm not telling you to buy DBS stock, but I'm simply telling you price action. $16. Anyone who had the nerve to go in there, and there were trend indicators which are telling you $16 was a reversal. At 16 bucks, you had the nerve to do it, and you need to have the nerve. You are sitting today with 17 and 99. The more bad things they write about the TBS, they're written some pretty nasty things in the papers, the better the price goes up. So there are time frames. Now bonds. Now bonds are commonly thought of as a diversifier. Be careful which bond you're talking about. If you're talking about corporate bonds, high yielders, they do not diversify. They are very closely correlated with stocks. You've got to be very specific in your language. What about bonds? Do they diversify? Yes, some. Yeah, not all. So then we talk about currencies. Now, we advise clients on currencies. So currencies can be treated in two ways. You can treat it as an overlay on your portfolio, or you can treat it as a source of alpha, which means it's a source of returns in itself. Decide which is your base currency. Your base currency presumably is the Singapore dollar. And your objective at the end of the game is to accumulate as many points in other currencies so you can swap it back to more Singapore dollars than you started out with. Not easy, but you can do it. We have been dollar bulls for a long time, and we have been absolutely correct on that. And we have generated a lot of alpha, a lot of source of returns for our clients, but we are now also warning our clients that this is getting close to the end of the bull market for the dollar. Nothing lasts forever. Nothing lasts forever. So the US dollar has tended to go up in 6-year cycles up, 6-year cycles down, 2 years in between sideways, 6 years up, 6 years down. History doesn't have to repeat itself, but it's generally a pretty good guide. So time frame is also important in terms of trading the currencies as well. Be careful what your timing is. Don't say long term and then 4 weeks you start complaining that you're losing your money. Now, if all that is too hard for you, you have two options. Come to DBS Bank. And I write a blog, right, with all my views out there. So you don't have to be a top private bank client to benefit from them. I'm just selling the goyo, as they say in Singapore. The alternative is, as all the other speakers have said, let time be your friend. I'm 58 years old, by the way. I've seen so many cycles, I can't even recall. Yeah, the first one I saw was in 1985, I think it was. It was the huge crash on Wall Street, Black Monday. I've seen them all come and go. If you have the ability to hang on, good stocks mean revert around rising trend lines. Well, one of my earliest clients is going back a long time ago, a very wealthy Singaporean, as you will gather from his accent. I said, what's the secret of your success? He said, I buy cheap, I buy whole, I don't sell out. And he's right. All right, look, shall I make my time 20 minutes? I'll allow myself 1 more minute to tell you a joke. Investment banker, Batman, was being led through the different levels of hell because he's had a terrible life. He's so CDOs. As he was led through a level 3 of hell, he saw an economist whom he knew. The economist worked for a bank across the street. The Economist was in a very nice room, a very plush room, having a very intimate conversation with a lovely young lady, right? And the investment banker said, hang on. He told the devil, hang on, how can this be fair? All right, I'm going to hell for selling CDOs because I work for a bank, right? But that man is an economist who works for a bank around the corner. He's also a banker. He's an economist. So why does he get to spend all eternity in that room with that lovely young lady while I get to burn for all eternity in the furnace of hell? The devil says you got it all wrong. It's not the economist who's being punished. He works for us. It's the young lady who's being punished. I hope I haven't punished you too much.